Hey guys, and welcome back to the Tax Savvy Real Estate Investor Series. In this video, I really wanted to address a question that I get quite a bit from clients, and that question is normally phrased as, "How does these multimillionaire, billionaire real estate investors pay near 0% tax or even get tax refunds on their major real estate holdings?" Right? So these big guys, they get multi-million dollar cash flows a month, and yet they're still paying zero or near zero tax on their real estate holdings. And I get a lot of questions on, like, what is Donald Trump doing and what can I do to get the same type of deduction in my real estate holdings. And that number one answer is normally 9 times out of 10 is the concept of depreciation. Right? Us as real estate investors, we understand the concept of depreciation. We see that line item on the tax return, but do we really know and understand what goes into that and how we can maximize that benefit as real estate investors? So in this video, I kind of wanted to address that, break it down a little, and see in what way we can maximize that line item of depreciation, right? So what is the depreciation? So depreciation is an annual income tax deduction in which the IRS allows an investor to write off the value of the property, right? So it's really an allowance for the deterioration, the obsolescence, and the wear down and tear down of the property, right? So it's a paper loss that the IRS really gives real estate investors every year to incentivize us to continue to invest in real estate. All right, and the formal IRS definition of depreciation is a tax deduction that allows a taxpayer to recover the cost of a property over time, right? And the thing about depreciation is, or the assets that we invest in, they have different depreciable lives or different lives where the depreciation is taken. For example, a commercial property is depreciated over 39 years. Residential property is depreciated over 27 and a half years, and land, which is tricky and what we have to be careful of, is land is not depreciated, right? So say we buy a property for $1 million that we will use in our example here today, but the value, $200,000 of that value is allocated to land. So we can't depreciate 200,000 of that a million. So the depreciable base in that property will only be 800,000, right? So another important thing to remember about depreciation, it's not about how much we put down on the property or how much we're getting financed on the property. It's whatever we paid for the property. That total big $1 million figure is our depreciable base minus the land. So we get this paper loss every year. It's no cash flow goes out for depreciation. It's just this paper loss the paper deduction on paper that we get every year to decrease our taxable income in our real estate holdings, right? So it's a powerful tool. It's a major tool, but it gets even better. So what these millionaires and billionaires do is that they lean onto their advisors and say, how can I benefit even more from depreciation? And 9 times out of 10, what their advisor advised them is some concept called cost segregation studies, right? So first, we're going to give an example. We're going to say our friend Donald J here buys a nice residential apartment for $1 million. And of that million, remember, 200,000 was allocated to land. So we have a depreciable base of $800,000. That's what we consider the building. And of the 800,000, we get to depreciate that over 27 and a half years for a yearly depreciation of $29,090 a year, right? So that's a nice round number that we get to just take off for just simply owning the building. But what if I tell you it gets better, right? So what these millionaire, billionaire real estate investors are advised to do is to get a cost segregation study. A cost segregation study is just that it's a study where you come in and you hire these engineering firms and they come into your building and they break property down based off of the other assets that are in the building, right? Such things as furniture or carpeting or, furnaces or, land improvements. And land improvements can include things such as fencing, parking lots, irrigation systems. So things that come in and improve land. So what these cost segregation studies do is they come in and break your building down into components. And the thing about those components is they have different depreciable lives than what we consider just the building, right? Such thing as those land improvements we talked about earlier or personal property. Those things like refrigerators, appliances, carpeting, cabinets, and on and on, are what we consider personal property. Personal property and land improvements are depreciated over shorter lives, normally 5 years, right? So instead of depreciating those items over 27 and a half years for residential property, we get to depreciate those certain assets over 5 years, right? So you can see that if we were allocated more to that bucket, we get to take a higher depreciation number every year simply by having this cost segregation study. And it breaks out the components of the building into other assets. So in this example, right, Donald J is advised by his CPA to go get a cost segregation study, right? So the cost segregation firm comes in and says, okay, of that $1 million purchase, right? We remember 2 million went to land. And so of the 800,000, 50% went to building. And 10% went to land improvements. And 20% went to personal property. So a total of 30% of that $1 million purchase went to items with shorter depreciation lives. So of that $1 million, 300,000 went to assets that are depreciated over 5 years. So we can see that we have a $60,000 depreciation added on to that previous figure, and that's not even including the amount that is still allocated to the building, right? So we can see that we increased our amount of depreciation by having this cost segregation study. Now we are paying less in taxes on our real estate holdings by getting a cost segregation study. And so you can see the power behind these tools. So if imagine this going from a $1 million residential property, but now these real estate investors who have billions and billions of dollars worth of real estate holdings, how that amount can reduce their taxable income, right? But it gets even better. Thanks to the Tax Cuts and Jobs Act in 2017, the tax code newly included this thing called bonus depreciation, right? So for certain assets, including the personal property and land improvement type assets, it says that in year one of after the passage of the law, 100% of those $300,000 was able to be expensed year one, right? So we could take that $300,000 and count it as depreciation in year one, right? But um, you can see how that saved millionaires and billionaires hundreds of $1,000s in taxes just off of depreciation. There's the limit now is no, we can no longer do 100% depreciation. For the year 2024, that number has gone down to 60, but even 60% on that 300,000 is a huge tax savings. So this is how, these millionaires and billionaires who lean onto their advisors are able to save large sums of money on taxes and, really tweak the game to really benefit them. And so when I advise my clients on getting these cost segregation studies, it's really a cost benefit analysis type situation because these cost segregation studies are quite expensive. So it's best to plan these studies on years where you think you will have high amount of taxes, right? So the cost of this cost segregation can still save you quite a bit of taxes in years where you will have higher taxes. So it's a powerful tool. It's a major tool, but you want to definitely speak with an advisor to see if this strategy works for you and work for your personal finances. So I hope you guys learned a lot. Hopefully it shed light on how these billionaires can really save on taxes by simply knowing the code and leaning on their advisors. So if you guys ever have a question, don't be afraid to reach out to us here at the SO Speak CPA firm. We love to be advisors and see how if this strategy or other strategies work for you. Thanks guys for watching.